Welcome to The Explainer. Today, we're unpacking one of the absolutely most complex yet, honestly, fascinating financial instruments in the modern market: options. Did you know that on some days, the daily trading volume of options actually surpasses the underlying stock market? It's literally a massive space. Now, for anyone who's ever wanted to speculate on an asset's price without coughing up the capital to own it outright, options are your vehicle. But make no mistake, they are a completely different beast from standard stocks. So let's break down the mechanics step by step.
So here's our roadmap for this explainer. We'll be moving through 5 clear stages today: the basics, the bull versus the bear, decoding premiums, the power of leverage, and finally, crucial risk management.
Let's start right at the foundation. Section 1, the basics, understanding options. The absolutely crucial point here is understanding what we're actually trading. Even though it trades on an exchange, an option is fundamentally just a contract. It's an agreement between two investors to speculate on a future price. And here's the magic part: this happens without either of them actually owning the asset at that exact moment. But, remember, because you aren't trading the underlying asset directly, options are exceptionally risky, like way riskier than normal financial markets. They really require expert knowledge to truly master.
To really grasp this, we need to move away from abstract definitions and jump into a real-world scenario. Section 2, the bull versus the bear, 2 opposing views.
All right, let's set the stage with 2 opposing forces. On one side, we've got our Tesla bull. The bull looks at the market, thinks Tesla is being mispriced, and firmly believes the actual value of the company is much higher. They expect the stock to rise over the next 3 months. They want to speculate on this view, right? But they don't really want to buy the actual Tesla shares. Now, on the exact opposite side, we have the Tesla bear. The bear has the completely inverse view of the stock's future, and it's exactly these 2 differing opinions that create a market.
Now, what's super interesting is how they formalize this disagreement. The bull and the bear enter into a very specific financial agreement. This contract gives the Tesla bull the right to buy shares from the Tesla bear at a predetermined price. In the industry, we call this the exercise or strike price. Let's say they agree on $165. So, exactly 3 months down the line, Mr. Bull has secured the absolute right to buy Tesla stock at $165 from the bear, totally regardless of what the market is doing at that time.
But wait, why would the bear agree to this? What's in it for them? Well, that brings us to Section 3, decoding options premiums, the upfront cost. Think about it. If the price goes up, the bear loses. If the price goes down, the bull simply walks away and doesn't buy the shares. It kind of sounds like a terrible deal for the bear, doesn't it? Well, enter the options premium. To safeguard the bear's interest, and really to compensate them for taking on this risk, the bull pays an upfront fee. Let's say it's $10 per share. This $10 premium is non-adjustable and non-returnable. The bear gets to keep this money no matter what happens 3 months from now. That's theirs.
Okay, let's see how this builds into real math with 2 possible outcomes in 3 months. First, let's say Tesla closes at $190. The bull exercises their right to buy at $165, which nets them a $25 gain. But remember that $10 premium they paid up front? We gotta subtract that, leaving the bull with a sweet $15 profit. The bear loses $25 on the stock but keeps that $10 premium, so their net loss is $15. Make sense? Now, outcome 2. If the stock closes below $165, the bull just walks away. Their loss is strictly limited to that $10 premium. And the bear? They breathe a massive sigh of relief and walk away with a clean $10 profit.
Now we can actually attach the proper industry terms to these mechanics. Because our bull was optimistic, they were dealing with a call option, which simply means the right to buy a security at a predetermined price. But what if a trader is pessimistic? Well, they'd use a put option. A put option gives the buyer the right to sell a security at a predetermined price. So if a bearish buyer holds a $165 put option and the stock completely crashes to $140, they still get to force the seller to buy it from them at that glorious $165 exercise price, pocketing that massive difference.
So you might be wondering, how does the market actually come up with that $10 premium we used in our example? Well, it's basically derived from 3 main factors. First, intrinsic value, or moneyness, which is basically how much inherent value the contract already holds relative to the current stock price. Second, time value. The further out the expiration date is, the more time the stock has to move, so the higher the premium. Makes sense, right? And third, implied volatility. The wilder and more volatile the underlying asset is expected to be, the more expensive the premium becomes. And this brilliantly illustrates the stark contrast and risk profiles between the two participants. The option buyer has the right to exercise the contract. This gives them an unlimited upside, while their downside is strictly defined. I mean, the absolute most they can lose is the premium they paid. Period. The option seller, however, has an obligation. If the buyer exercises, the seller must comply. This means the seller has an upside strictly limited to the premium they received. But, and this is huge, they are exposed to theoretically unlimited downside risk.
This asymmetry of risk and reward is exactly what draws people in. So let's transition to Section 4, the power of leverage, magnified returns.
You know, back in the day, in a decentralized, non-digitized world, finding someone to take the other side of an options contract was an absolute nightmare. But modern technology has completely removed all that friction. Today, it literally takes just 3 steps on a brokerage app. Pick the asset, pick your strike price, and pay or receive the premium quoted on the exchange. Boom. It happens with the click of a button. And while that's super convenient, it also makes it dangerously easy to expose your capital to the explosive mechanics of leverage. Here is the real wow moment that defines options trading. Premiums fluctuate wildly based on the underlying security. Imagine you pay a $10 premium when a stock is trading at $100. If that stock moves up by 20% to $120, that $10 premium doesn't just go up 20%. No way. Because of the magnifying effect of leverage, that premium could easily skyrocket to $25. The underlying asset moved a respectable 20%, sure, but your option premium delivered a staggering 150% return. But we absolutely have to look at the flip side. Leverage is a brutal double-edged sword. If that underlying stock drops by 20%, your premium doesn't just take a little dip. That same premium can suffer a devastating 90% wipeout in an instant. The very same mechanism that multiplies your capital can effortlessly wipe it out. Which brings us to the final and unequivocally most vital part of our explainer. Section 5, crucial risk management. Survival is everything. Look, randomly buying and selling options is a mathematical guarantee of failure. To succeed, you absolutely must have a system with a positive expectancy. First, you have to identify underlying assets that you can intimately track and understand, whether that's stocks, indices, or commodities. Next, you need a defined mechanism to foresee price movement based on actual quantitative data or sentiment. For example, if your philosophy is breakout trading, you monitor the underlying stock patiently and you only buy call options when that precise chart breakout actually happens. You're trading specific conditions, not just making wild guesses. And that brings us to your ultimate golden rule, 2%. Because of that magnifying effect of potential losses we talked about, the absolute best options traders never risk more than 2% of their total capital on a single trade. Unlike stocks, option trades have a very real, very frequent potential to go straight to zero. If you have a large exposure, a sharp loss is going to be fatal to your account. Start small, build the skill set, and really prove your system works before sizing up. We're going to wrap up this explainer with a question you should honestly ask yourself every single time you open your brokerage account. If a single click can multiply your capital or instantly wipe out your premium, is your trading system built on quantitative data or just pure emotion? Options are a ridiculously powerful tool, but they demand absolute discipline. Thank you so much for joining me for this breakdown. Keep learning, keep your risks small, and I'll see you in the next explainer.